Well, let's wrap up our discussion and explanation of stock indexes. And we need to review here rebalancing and reconstitution. Remember, rebalancing is updating the index weights on a periodic basis. Now, we had to do that periodically with an equal weighted index because price changes change the weights from equal weights. We had to do it with a price-weighted index in the case of a stock split because the price changed because of the split. So we had to change our weights all around. We had to reconstitute the index. Okay? And with a value-weighted index, we didn't have to really rebalance it. But with a value-weighted index and the other indices, we would have reconstitution, periodically adding and deleting securities from the index. Well, in terms of uses of index, we started out saying, well, it just gave us a measure of overall market performance for a number of stocks, so you didn't have to just look back in the day at U.S. Steel and AT&T and Consolidated Edison or whatever the stocks were back in the day. They put them together into an index. So it's a reflection of market sentiment just from the price movements. But they're also used very much these days as performance benchmarks. Remember when we were talking about portfolio management in an investment policy statement, we said, well, there needs to be a benchmark so we can compare the results of active portfolio management to passive portfolio management, just matching it one of those weighting schemes. It's a measure of market return. We use an index when we're calculating beta, estimating the sensitivity of a stock relative to the performance of the overall market. Okay? And we use them to calculate expected and risk-adjusted returns. Remember, we had expected returns based on a stock's beta and the return on the market. So we can say, well, if the market return over the period was this, okay, and we know the beta of the stock, then we go, well, our expectation of what this stock performance would have been is this. So that's how we would calculate the expected returns, and then we can do risk-adjusted returns, beta being our measure of risk. We can use that estimate of expected returns and say, well, what did it return compared to what we would expect the return to be, given the returns on the overall market and the beta, the market sensitivity of this stock. And also, it's the model portfolio for index funds, the largest of which being the S&P 500 index funds. So types of equity indexes. Well, this is just terminology here. The broad market, with various weighting schemes. We certainly took a good look at those weighting schemes. We could have a multi-market, market cap weighted index, just telling us that across multiple markets, we would use the market capitalization of all the constituent securities in each market and then invest in each market in line with its proportion of the total value across all the markets that we're including in our index. A sector index might be the constituent securities or healthcare funds or healthcare companies or technology companies or consumer goods companies. And a style index refers to large cap, mid cap, small cap. That would be one measure of style of investing. Okay? Or value versus growth. Often value is represented by stocks with low price earnings multiples, and growth stocks, those with the higher price earnings multiples. Since their earnings are expected to grow, investors are paying more for a dollar's worth of their current earnings than they would for companies where less growth or no growth is expected. We can also have fixed income indexes, and we can define these by maturity, a long-term corporate bond index, short-term corporate bond index, or by the type of issuer, municipal tax-free bonds in the U.S., or corporations versus sovereign debt like U.S. Treasury securities, country indexes, region indexes, sector, or based on the type of collateral that stands behind these fixed income or debt securities. And the construction issues are a little more difficult than with equity securities. One is there's a very broad universe of bonds compared to equities. You can see companies may have several bond issues outstanding, different maturities, different collateral, different features. Okay? And there's high turnover because bonds mature and just go away, or they get called according to the call feature embedded in the bond. And we don't really have that problem with equities. They don't just regularly disappear. And some bonds just don't trade. There's not that much liquidity in the markets. They don't trade regularly, so we don't get good price data on them. So the illiquidity, you might not be getting any price data at all, or we may just get periodic price data. So these are all problems in constructing fixed income indices. We can also have indices of alternative assets, indexes of futures contracts. So we might look at precious metals futures contracts. So if we didn't want to just look at gold, we wanted to look at platinum, and gold, and silver. We put that into an index and we could track it that way. And there's a wide variety of commodity weighting schemes in commodities index. So if you wanted as an inflation hedge to hold a commodity index, it might have exposures to wheat and corn and copper, steel, whatever. Real estate index, well, real estate indexes can be based on different prices. Okay? It could be based on an appraisal. Okay? Well, appraisals are smoother than market prices, so those indexes, we consider them to be kind of smooth and not as volatile as the actual market values would be. The repeat sales index, well, a repeat sales index says, well, let's just use prices when things trade. And so since we only have those prices, we'll compare them to the previous sales prices of those that have sold. So that's the idea of looking at repeat sales. So it's actual price data, but it may be biased price data. Those properties that sell more often, change hands more often, may have a different set of characteristics than the overall real estate market that we're looking at. And REITs, real estate investment trusts, well, they hold properties, but they actually trade on an exchange. So we see more of that market volatility in those indexes than we would with appraisal indexes. And hedge fund indexes, we look at the performance of a group of hedge funds, and we run into, with these index returns, we run into self-selection and survivorship bias that increase returns, because we want to look at an index of firms that have been around for a number of years, and that's where the survivorship bias comes in, because those firms that survive longer are just those that have had better performance. Hedge funds that don't perform well just don't survive for long periods of time. And so that survivor bias, we've got a set of hedge funds that we know have had better than average performance because they've survived long enough to be represented in our index. And now this is just a listing that you can look over of types of security market indexes. Just ones you should possibly be familiar with, but some of them, the topics, for example, just might not come up. All stocks on the Tokyo Stock Exchange first section. Okay. This one right here. And we see the constituent securities. Now only 30 in the Dow Jones, 225 in the Nikkei stock average. And then there's some notes, okay? The Dow Jones stocks are chosen by the Wall Street Journal editors, okay? The Nikkei contains some illiquid stocks, and there is some adjustment for high-priced shares. But the Topics contains 93% of the Japanese market, so there'll be many small illiquid stocks in that. So certainly you aren't expected to memorize this, but just to understand some of these differences. And the Topics is a float-adjusted index, which we covered. Some other ones, the MSCI All-Country World Index, okay, 23 developed and 22 emerging markets. So that's an awfully broad index there. What's their weighting scheme? Market capitalization adjusted for float. Barclays Capital Global Aggregate Bond Index, okay, and that's based on the market capitalization, that is the total outstanding value of the bonds. And some last ones here for you to look at. High Yield Bond Index here. See, High Yield Bond Index, National Association of REITs, Global Real Estate Index, and the Global Hedge Fund Index. And so just some examples of various types of indexes. So that about does it for security market indexes. A couple more here. Morningstar Style Index. I forgot. U.S. stocks grouped by value, growth, and market cap. So that would mean large cap value stocks, large cap growth stocks, or mid cap or small cap volume, small cap value stocks versus small cap growth stocks. Okay. You got 9 categories then, combinations of 3 small, mid, and large cap, and 3 value versus growth pairs.